All right, we're getting ready. I see you out there. Make sure we have our notes. Okay, and let's get started. Hey there, I'm Mitch Goldberg. You're watching my live stream. It's called Be the Boss of Your Money. Today's a special day because we had the rally from I don't know, the rally from heaven. I don't like to say that. We just had a huge rally. So if we had a market from hell, I could say that. So we had a massive rally today. Boom. Huge rally. Stocks way up, especially from their lows of the last couple of months. What gives? Did you buy in the dip? We spoke about that the other day, right? Did you buy? Did you put a little money away? If you sold the last couple of days and you're now racing to buy back what you sold, you're doing it all wrong. You're doing it all wrong. How about create an investment portfolio that you could live with based on your time horizon, your risk tolerance, your financial goals? I know that sounds like really boring, and maybe it's not exciting enough for you. But when you have a NASDAQ that goes down 25% quickly, and you've got so many stocks that are down 60, 70, 80% or more, that's not the kind of excitement you probably wanted, right? So you stick with a good portfolio, and then you do other things that you could control while your portfolio goes through its natural ups and downs, but over time with a trend higher. Doesn't that make sense? Anyway, today is also exactly why I prefer to use put options to short a stock as opposed to outright shorting a stock, because a day like today could literally rip your face off if you're shorting stocks. And now you have no idea what to do. And with the rally we had today, I personally, based in my experience, I would not be surprised in the least to see today's rally continue into tomorrow with not just a little rally, but another big rally. This rally we had today is one of the biggest rallies we've ever seen. So if you didn't know about it, we're going to talk about it. The Dow up over 900 points. All the major averages up huge. Stocks that have gotten slammed have taken off today. I'm not talking about like the the little pandemic. Well, yeah, the little pandemic stocks. Okay, I'm talking about quality names like a Starbucks, for example, like bank stocks like a JP Morgan. Stocks that really have taken it on the chin have bounced back hard today. Quality stock rally, like the ones that you held, like you hold the beach ball underwater. The further underwater you hold it and you let it go, the higher it's going to go when it reaches the surface. All right, that's kind of what we had today. All right, so we're going to talk about this. The Fed raised rates, so much going on in one shot. So let's roll the intro. I'm going to give you the update, what you need to know. We're going to talk about be the boss of your money, controlling yourself, your money, your behavior. Here we go. All right, just getting our no memory card. Yeah, we know that. We're just getting our show started. Got the notes over here. I do manage to sometimes scribble some notes on a pad before I get the show started. I want to make sure there's some important points we don't miss. And sometimes there are days I just literally turn on the mic and the camera and I just go. I just do it because I'm busy. I have a life too. I do other things. Live streaming is something I love to do, but it's not my whole life. It's part of my thing. I enjoy it. It's part of my marketing. It's part of how I bring in new clients, update existing clients, and I get so much extra content out of my live streams. But mostly, I enjoy doing it. You couldn't do this every day if you didn't really get something out of it. All right, just letting you know. All right. So what's the story? Today is May 4th. May the 4th be with you. Today is Fed Day. The Federal Reserve today wrapped up a 2-day meeting. Okay, it has 8 meetings a year. The Federal Reserve Open Market Committee. That's the body at the Federal Reserve that decides on what to do with a lot of policies, like what to do with interest rates, raising short-term rates or lowering short-term rates or leaving them alone, buying back, buying bonds, quantitative easing, things like that. The FOMC, the Federal Open Market Committee, headed by Jerome Powell, chairman of the Federal Reserve, unanimously, they decided to raise rates, announced it after the 2 day meeting, which ended today at about 2 o'clock Eastern, that they're going to raise short term rates by 50 basis points, which is, more than what we're used to over the last couple of decades, like the last since 2000. I think early 2000 was the last time the Federal Reserve actually raised rates 50 basis points. It usually goes 25 basis points at a time. So Fed raises rates 50 basis points. This was exactly as expected. We've been talking about this, and you've been reading about it all over the media as well. And the Fed had its post-meeting conference with financial journalists who asked them all kinds of questions, very good questions. I think financial journalists are some of the best around, by the way. Um, it's like very easy to find a financial journalist who is, trying to shape things in their way, because the numbers in the market don't lie. You can't what's the word I'm looking for? What the hell is the word I'm looking for? When when you try to shape information to to get a certain result, you're trying to follow a certain narrative. Anyway, you can't fudge it. So, the word evades me. Anyway, the Fed has, people are expecting the Jerome Powell to be more hawkish in his post-meeting comments, and he wasn't. He wasn't as hawkish as people expected. He said basically a 75-point rate increase is off the table. Right there and then, stocks started to peak up because he's not really as aggressive, as hawkish as investors expected to fight inflation. He pretty much is going to. He pretty much said 2 more 50 basis point hikes. We're at about 1% now, so he'll get us to 2% pretty quickly, and then maybe 4 more quarter point hikes. All right, I think there's 5 meetings left. There's 5 or 6 Fed meetings left this year. One extra meeting or not, 5 or 6 doesn't matter. So that's what he is going to do. So he's going to raise rates. He laid out the map of what he's going to do. It's not as bad as we expected. Now, granted, information could come in which could push the Fed to being more aggressive or less aggressive than what we expect now. But right now, we expect the Fed to become to stay where it was going to stay, not too hot, not too cold, and try to engineer a soft landing for the economy. In other words, the Fed wants to slow the economy down, but not slow it down so much that it goes into a recession. It's a tall order. A lot of people, for a very good reason, doubt if the Fed could do it. They think the Fed's going to send the U.S. economy into a recession. If it happens, it happens. But you've got to wring out inflation. You've got to wring out excesses. Stock market be damned, right? The Fed should not be in the business of the stock market. And that's what I said yesterday in the last couple of days. The Fed should not be in the stock market business. I've been saying this for years, my 30-plus year career. And the market will do what it's supposed to do. And today, the Dow just literally took off like a shot. So let's take it to the big board. Let's take it to the U.S. markets. I'm just going to get my screen ready. This is one of those days where I basically just flicked on the switch and I'm winging it because I've just been just a crazy day today. Let's share the screen. Okay, here we go. Let me get my social media icons out of there. Okay, by the way, news just coming across the tape. 1 million COVID deaths, right? That's a very sad milestone. Let's all have a moment of silence for these people. All right, but we're talking about the market. Dow up 932 points, up almost 3%. Now we've had, last Friday, the Dow was down like 980 points. So, and that was, 3.5%. So as you can see, the way the numbers work, the Dow has to go up a lot more to get the same percentage on the way up as it did on the way down. But nonetheless, today was a pretty good clawback after what a lot of people thought would be a pretty tough day in the market because the Fed was going to raise rates and come out and announce how hawkish they're going to be. The Fed thinks that inflation is not far from peaking. The Fed also acknowledged they can't do anything about the supply chain shocks. You know, a lack of oil, a lack of wheat, lack of semiconductor chips, lack of all kinds of materials and products because of COVID shutdowns throughout China and because of the war in Ukraine. But and, supply chain disruptions. But he said they are really focusing on demand, and there's a lot of demand, and the Fed wants to tamp down demand by making borrowing more expensive. And since this country's economy revolves around credit, you make borrowing more expensive, you slow the economy down. Consumers have less money to spend on things, and businesses have less money to invest in projects. It also makes people smarter with the money that they do have, by the way. When you have scarcity of money, you really have to focus on the best returning investments if you're a business, as opposed to just throwing money against the wall and seeing what sticks, right? Take it from me, I am a business owner. All right. The Dow up 2.8%, NASDAQ up over 400 points, up over 3%, S&P up almost 3%. Tech stocks had a big day today. Oil up big, up over $5, over 5%. That is a big move for oil. The 10-year yield barely budged, about 2.95%. The VIX came down quite a bit, down to 25.42. And I always say, VIX goes below 20, we've got a continuation of a rally. We've got a rally in our hands if it goes below 20. But this is a very good time to what I call upgrade and the downgrade. If you have stocks that you are really worried about, that you were thinking you should be giving up on, or it doesn't have to be stocks, it could be sector funds, exchange traded funds. If you have an investment that you were really thinking about giving up on, and it's had a nice rally, you might be getting to the point where maybe you should let that one go out of your portfolio and swap it into something higher quality. Don't think because something's down so much that you have to wait for it to go up more. Quite often, the recoveries you have, the rebounds you have, are not going to be in the same investment as the one that created the loss. Just so you know. All right. So that's one of the things that we have to look at. So the Fed has come out and said they're not going to do a 75-point rate hike. They're going to stick with two more 50s. It's definitely a lot more, so it's a lot less bearish, a lot less hawkish than what the market expected. All right. So we've got two more meetings coming up in June and July, and then there's no meeting in August. The next one we get is September. So we've got a while to see what the Fed's going to do. But I think the way to look at today's huge rally is that short covering, investors who were shorting stocks or shorting the market went to cover. And once those stocks go up, the next short seller has to cover. Because when stocks go up and you're selling something short, you're losing money when stocks go up. And the difference between losing money when you're shorting a stock as opposed to losing money when you are long a stock, when you own a stock, is the worst you could do when you own a stock. Obviously, if you're not on margin, the worst you could do is when you own a stock is it could go to zero. When you're a short seller, the worst a stock could do is keep going up and up and up, and the losses potentially could be unlimited. I mean, it's kind of theoretical, but you could see massive losses. And when people short, they usually don't short with a whole ton of capital. They usually short on margin. But now that we are all of a sudden more comfortable with the market, investors are more comfortable with the market, the inflation outlook, the interest rate outlook, maybe investors have sold off the market too hard, and it's time to bring the market back up. And that's what's happening. So there's not really as much of a reason or an impetus to short the market the way people are shorting it. The other thing is a lot of investors, I'm talking professional investors as well as retail investors, that's us, but the professional investors, that's me too. I know, I'm a professional. I'm a pro at this. I know, but don't hold it against, don't hold my pro status against me, okay? I'm sharing everything with you. Where the F was I? Oh, yeah. Yeah, so people sold, and they decided things aren't that bad. I have to buy back. Now, if you're a fund manager and you have to make quarterly numbers and annual numbers, and the market goes up and you're sitting in too much cash, you could actually be underperforming the market because of a recovery. So now fund managers have to put cash to work. All of a sudden, there's a race to chase performance. And fund managers, they'll buy what is working. They just want to put money to work, and that moves the market higher. Short sellers start covering more, and investors who are nervous, who are sitting in cash, or if you just made your retirement plan contribution and now you're thinking, maybe I ought to put that money to work. That's the kind of rally we could have that could carry the rally into tomorrow, um, and Friday and beyond. All right. We don't need the market to go up huge every day, but this is the kind of day where I normally don't like massive rallies because then we repeal them too quickly. But this one does look rather sticky because the outlook on what the Fed is on what the Fed is expected to do has changed. And if the facts change, you have to change your mind. But we don't really get too into this. We don't make short-term moves based on all this stuff. Um, in the last few weeks, I've made hardly any moves in client accounts just because we're already set up the way we want it. Now it's just waiting. Today's a perfect example of why it pays to wait and don't make sudden moves because you all of a sudden think we could go into a recession or the economy or the stock market could go down a lot. I want to talk about this now also, okay? I'm going to go to a different camera for this. And the stock market are inextricably linked, but they're not the same thing. In other words, the Federal Reserve could get inflation down. It could tamp it down with its policies of raising interest rates and letting bonds roll off its massive balance sheet. But the economy doesn't have to go into recession, but with higher rates, it changes how stocks are valued. That alone is enough to drive stocks into a bear market. I think we as consumers see so many people talk about, are we going into a recession or not? And, and the soothsayers, the strategists, like I'm one of them, I know. But a lot of them, they start to talk about the economy, this, the economy, that. Are we talking about the stock market or the economy? So you might start to think, oh, it's the same thing. It's not the same thing. We could actually still have a halfway decent economy in the next 6 to 12 months, and the stock market could still take it on the chin and plunge. They're two different things, and the stock market doesn't necessarily trade off of and follow the economy in perfect synchronicity. You should know that. Okay. What else do I want to talk about? Those are really the big things. It changed the technical picture. The technical picture was that investors decided to sell stocks and protect any gains that they had from the pandemic market. The stocks went up and they see them going down. And people are like, I better just protect my gains and get out. Now we went back to saying, wow, this was a dip that was probably worth buying. I'm not saying every dip is a buy. And I think it needs to be acknowledged by everyone. When you hear most people talk in my position, when you hear most financial advisors talk about stocks, we're really talking about investors as if they were just investing in index funds. Okay. Passive diversified investors. By the way, you cannot invest directly into an index, but you could invest in a security that tracks or mimics an index like an index fund, right? So we talk about, the market's down 8% or 9%, not a big deal. The market always comes back. It's not a big deal. We're talking about more diversified funds, okay? Diversification is a strategy that we use to reduce risk, that we could use to mitigate risk potentially, but it doesn't necessarily protect your portfolio from going down in a generally down market. So I got that right in there. So individual stocks, it's a little bit different. You could be in individual stocks and then hear someone in financial media say, oh, the market should recover, or, it's always recovered X amount after X amount of down days, or this year has been a tough year. And typically we have years in the beginning like this. We usually have very good rallies in the second half, and many of those years are up. But that doesn't go for individual stocks. Nobody could say anything historical about how that would work regarding Peloton or DoorDash or Uber or lots of other pandemic stocks that have gotten absolutely mauled. We could say that about an index fund or a mutual fund, but we can't say that about individual stocks. The risks and rewards are so different when it comes to investing in individual stocks versus funds. It's almost like we're talking about two different things. So as an investor, you could be down severely in stocks. Severely, you could be down 70, 80%, even though the S&P 500 is down less than 10% from its high. It's probably down about 10% after today's rally. You regardless, what's the best way to say this? Individual stocks, you could be down a lot more, and individual stocks don't necessarily recover and go to new highs. Index funds do. These index funds, they're not just for diversification, they have a way of throwing out losers and replacing them with new winners. Index funds are regenerative as well as offering diversification, and they offer lower fees as opposed to individual stocks. Right? Nothing offers lower fees than holding individual stocks, by the way, just so you know. Okay. There is a fee for an index fund, but for holding individual stocks, there is not a fund fee for those. Just so you know how this works. So we need to talk about how there's a difference in the risk equation for index or mutual fund investors versus individual stock investors. I see so many stocks that have gotten crushed so badly. I don't see these stocks ever coming back. And I talked about that on the show. This is why I avoided meme stocks, SPACs, pandemic stocks. You've heard me say all this stuff before, and now you could see why. It doesn't matter how good short term the reward is. I've seen this movie before. I went through the 2000 tech wreck. I've seen it. I've seen it happen, and it was textbook. It happened exactly the way we thought it would happen. First, you see the tertiary stocks go down, then the secondary, and finally, the big stocks start to get hit where everybody's hiding in, like the Googles and the Amazons and the Facebooks and the Netflixes. And you see those stocks have gotten mauled from their highs. All right. So I think that's about it. It was a pretty good day, really good day in the market. I don't get excited much about one day. I'm not making dramatic changes to client portfolios, just like I didn't make dramatic changes to client portfolios on the way down. We just invested the way we're supposed to invest. And now we focus on things like investing every month, dollar cost averaging, properly insured life insurance, things like that, updated estate plan, tax efficiency, Roth IRAs versus traditional IRAs. We get into the things that we could control. There's a lot of things that you could control as an investor while the market's down. Have you ever met a long-term investor who's met with tremendous investing success? They have seen ups and downs, but it's their patience level that has allowed them to get through the downs so they can enjoy the new ups. And the new ups have always been higher than the ups before them. The lows have always also been higher than the lows they've been. So food for thought. I hope you enjoyed this. If you have any questions, hit me up in the comments. And I will see you. Oh, I'm not going to be here tomorrow. I mean, I'll be at work tomorrow, but I'm not going to do the live stream tomorrow. I have tickets to see Metaverse Madness, the new Doctor Strange movie, the new Marvel movie. I am so looking forward to it. I bought 8 tickets. I'm going, and my kids and 6 of their friends. So 5 of their friends. So it's going to be a great time, and I just can't wait to see that movie. And I'll let you know how it is the next time we speak. If anything crazy does go on during the day tomorrow, I'll be on the live stream. If anything goes on Friday, I'll be on the live stream. If not, I'll see you Monday. Thank you so much. Have a great day.